A category of digital asset once treated by much of the mainstream business world as a crypto sideshow is now being folded directly into the regulated US financial system under a formal federal licensing framework, with major banks actively evaluating their own entry into the space. This video breaks down what stablecoins actually are, why the regulatory landscape just shifted decisively, and what the resulting payment infrastructure shift concretely means for businesses, including ones with no interest in cryptocurrency as an investment category. Stablecoins are digital tokens designed specifically to hold a fixed value, most commonly pegged one-to-one to the US dollar. Unlike more volatile cryptocurrencies, whose price is determined by open market trading and can fluctuate significantly, a well-designed stablecoin is backed by reserve assets, typically short-term US Treasury bills, cash, and similarly low-risk instruments, held by the issuer specifically to back the token's value and support redemption at par. This design purpose matters enormously for how stablecoins get used in practice. Their entire value proposition rests on price stability, which is precisely what makes them potentially useful as a payment and settlement instrument, distinct from cryptocurrencies whose price volatility makes them poorly suited for everyday commercial transactions or as a store of value for near-term business operations. For years, stablecoins operated in a genuine regulatory gray zone within the United States, used increasingly for real payment volume, but without a clear, dedicated federal legal framework governing who could issue them, how they had to be backed, and what oversight applied. That changed with the passage of new federal legislation, establishing for the first time a formal licensing and supervisory framework specifically for payment stablecoin issuers. Under this framework, issuers must obtain formal approval, maintain specific reserve backing standards, provide clear redemption rights to holders, and comply with Bank Secrecy Act and anti-money-laundering obligations in the same manner as other regulated financial institutions. The framework establishes multiple categories of permitted issuers, including banks issuing through supervised subsidiaries, other federally qualified non-bank issuers, and state-qualified issuers under coordinated federal-state oversight. Federal banking regulators have been actively working through the detailed implementing rules for this framework, covering capital requirements, custody standards, and deposit insurance treatment for reserves, moving the space from broad legislative principle towards specific operational supervisory requirements. This regulatory clarity is precisely what has shifted stablecoins from a niche product primarily used within the cryptocurrency trading ecosystem toward a category that traditional, systemically important banks are now treating as core strategic infrastructure. Several major banks have been actively evaluating whether to issue their own stablecoins directly or partner with existing issuers, viewing this as a decision with real competitive implications for the future of payments, not unlike how banks once had to decide how aggressively to invest in early online and mobile banking infrastructure. For businesses, the practical appeal of this shift isn't speculation on token prices, it's settlement speed and cost, particularly for cross-border and business-to-business payments. Traditional cross-border payments routed through the conventional correspondent banking system often take multiple business days to fully settle and carry meaningful transaction fees layered across multiple intermediary banks, a cost and delay structure that disproportionately affects smaller businesses without the scale to negotiate the most favorable banking relationships and foreign exchange terms. Stablecoin-based settlement, by contrast, can in many cases clear near instantly around the clock at meaningfully lower transaction cost because it bypasses several layers of the traditional correspondent banking chain. This is precisely why a number of large payment processors and several public companies have already begun moving real transaction volume onto stablecoin rails for specific use cases, particularly cross-border business-to-business payments, supplier settlement, and treasury operations where speed and cost genuinely matter at scale. This shift is also creating broader financial market dynamics worth understanding, even for businesses with no direct stablecoin usage, because stablecoin issuers are permitted to hold reserves primarily in short-term government securities. Rapid growth in stablecoin adoption has real implications for demand in short-term treasury markets, a detail more relevant to macro-level market observers than to most individual businesses, but a clear signal of how quickly this category has moved from a niche crypto product toward a genuine, market-relevant piece of financial infrastructure that regulators and large institutions are treating with corresponding seriousness. It's also worth noting, in the interest of a balanced picture, that this remains a developing regulatory and market environment. Questions around yield, whether stablecoin holders can earn interest, and how that interacts with the framework's design, along with the pace of final rule implementation, remain active areas of policy discussion, and outcomes here could still shape how quickly and in what form business adoption accelerates. None of this means every business needs an active stablecoin strategy today. For most small and mid-sized businesses without significant cross-border payment volume, this remains an emerging piece of infrastructure to monitor rather than an immediate operational necessity requiring action this quarter. But it does mean the underlying payment infrastructure landscape is shifting under an increasingly clear formal regulatory framework, with major financial institutions treating it as strategically significant rather than experimental, which is historically a strong signal that a technology shift has moved past its speculative phase. Businesses with meaningful cross-border payment volume, international suppliers, or treasury operations sensitive to settlement speed and cost should be actively tracking how this space develops over the coming year, since the competitive advantage of faster, cheaper settlement is exactly the kind of edge that compounds once a competitor adopts it first, and you're left explaining a multi-day payment delay to a supplier who's already moved on. This analysis is for informational and educational purposes, drawn from public reporting, shipping data providers, and government sources. It is not investment, legal, or policy advice. This is the Katakyie Brief. While everyone talks about the military side of geopolitics, we track the boardrooms, the balance sheets, and the breakthroughs that quietly redraw the map. Because the next war for power won't just be fought with weapons. It'll be fought with technology, capital, and ideas. If you want to stay ahead of that shift, subscribe, share this with someone building in the space, and follow for the next brief. Stay sharp, stay ahead. This is the Katakyie Brief.